Are you interested in generating passive income through dividend-paying stocks? Well, you're in the right place. In today's video, we're going to dive into the exciting topic of how you can generate £100 in monthly dividend income. We'll explore the key factors to consider when selecting dividend stocks, how to calculate the number of shares needed to reach that £100 mark, and much more. So if you're ready to unlock the secrets of building a substantial income stream that's completely passive, let's jump right in. And don't forget to drop one of these, as it does help with the YouTube algorithm. So firstly, how can dividend paying stocks generate passive income? It's an important question, and if you didn't know, dividends are paid by companies and they are generated through surplus capital in the business. A business might go, we're making X in profits, we're making £100 million per year. We could invest it back into the business, but actually we also want to reward shareholders, and we feel that we can give back value to shareholders by also paying out a dividend from some of those profits. So for instance, a company could give out £20 million of that profit as dividends, which is then paid to us as a shareholder for holding shares in the company. So as long as you hold shares in the stock over the X dividend date, this means that you're eligible for a dividend and then you'll receive it on the payment date. Therefore, holding shares and having a high number of them over a period of time means that you can bring in dividend income absolutely passively, and all you've got to do is press that initial buy button. Now, what factors should you consider when selecting dividend stocks for consistent income? Because so far it sounds incredibly easy, and I don't want to mislead you. The principle of dividend investing is certainly quite simple and easy to understand, but I do think there's a lot of intricacies involved that could certainly impact an investor and turn them down the wrong direction, where this passive income stream might have some income stream, but you might lose more than you've invested, as there's always a risk with investing in the stock market. So I look at quite a few factors that dictate whether or not I'm looking at a high quality dividend stock. There's obviously more things to look into, but let's start right here. So first things first, I'm on a website called dividend-data.co.uk, and I'm looking at a company called Shell. I can see here that the dividend yield is 4.41%. Firstly, I look at the dividend yield percentage. If it's a number above 5%, likely there's a reason as to why it's that high. Because, and I mean this interest rate environment is certainly changing the dynamic of dividend stocks, where we may see dividend stocks sit at a similar level of interest rates, but what incentivizes an investor to buy said stock over the current base rate? Well, at the moment, the interest rate is about 5%, so if there's a yield above 5%, there's a reason why investors aren't buying it. Now, this is more given away when you're looking at a stock that has, say, an 8, 9, 10, 11% yield, right? Because with a 10% yield in 10 years, you've gotten your money back on your initial investment. That sounds fantastic, and usually it can be too good to be true. This is called a high yield dividend trap, so do be quite careful on this. I see it as an initial red flag. It doesn't turn me off the investment, but I go, okay, that dividend yield's high, why is that? To understand something here that is important for context, if a dividend yield is high at 10%, and this is attractive to investors obviously because that's 10% in annual income, right? Well, investors would buy more shares, and what would happen is as they buy shares, the price of the stock will go up. As the price of the stock goes up, the dividend yield percentage will go down. This is because the share price has increased, but the actual amount they're paying in dividends per share is going to likely remain the same in that period. Therefore, the yield percentage will come down. So if it's a stock that a lot of people are buying and they think it's got long-term good prospects, the yield is probably going to be a lot lower. I do also find it useful to look at the history of the dividend yield. Is this sitting along the average? Well, actually, when we look at Shell, you can see here that at the end of 2020, it had a massive cut downwards. Again, another potential red flag here. And we go back before that, and you can see that the average yield floated somewhere between about 5 and about 7%. So at the moment, it's on the low end. And why might that be? We can see here that it's a quarterly dividend payer. Now, dividend frequency is encouraged by a lot of dividend investors, right? If you want £100 a month in passive income, you've got to have stocks that pay out 2 or mainly 4 times per year or quarterly. There are some stocks that pay 12 times a year. They're quite niche and they're normally real estate income trusts I'm not going to get into in this video. But you want a stock to pay out frequently. That's the importance of it. However, not all companies have consistent cash flows where they can pay you as frequently as quarterly or let's say once every month. So you need to be careful here, because if you're prioritizing a stock that can pay out a dividend based on your criteria, the quality of the company itself might be worse off, because you're sacrificing perhaps the quality of the company for this dividend frequency. This dividend frequency could make the business more resilient. It might mean they have a healthier balance sheet, and it means that if they come into tough times, hey, look, they've got a lot of capital that they can use because they've got this cash flow that's not being paid out as a monthly dividend. That said, the trick to get around this is holding a diversified number and a large sum, let's say, of dividend stocks. Say you have 10 quarterly paying dividend stocks in your portfolio, eventually you'll have enough stocks in there that you're getting frequent dividend payments, and you're getting 40 dividend payments a year, which will likely mean that in some months you're getting slightly more, but overall you're getting money per month. And I also look at the dividend history. This is important here because it tells us a lot. If the company is consistently growing the dividend over the longer term, and it looks like a staircase that is consistently going up, and if it's getting steeper at the top, fantastic. That's a great sign. That means that they're dedicated to their dividend and they're committed to paying it and growing it over the longer term. We can see here with Shell, well, this is an oiler, so this is probably not a fair example, but you can see how they've grown it somewhat, and then it's flat, and then in 2020 it was actually cut. Now this was a record-breaking cut because they had been paying a dividend since World War II, and obviously that has changed in that moment. But again, they cut the dividend here and they've started growing it back up. So unfortunately, the compound annual growth rate here is negative because the cut was in the last 5 years, hence the negative figure. But a good quality company will be growing their dividend at, let's say, 8% per year over a 10-year period, and that's a great factor to look for. One of the more important factors that I'll get into now, and I'm using simply Wall Street for this, is the earnings payout to shareholders, or the payout ratio. Typically, you want this figure to be low. So this means of their overall profits, as we said before, a company's earning £100 million per year, 18% means they're only paying £18 million out as a dividend, meaning they can reinvest the other 82% back into the business, whether they want to do share buybacks or invest in their own operations or make acquisitions and such. This is a very important metric because it means they can grow the dividend over the longer term. Because Shell's dividend payout ratio is so low, obviously we need to evaluate the earnings furthermore to see if this is normal, if they've had a very good year for whatever reason. And then we could say, well, okay, it was 18%. They could keep growing this until it reaches about 50%, which I still think is a modest payout ratio and quite a fair amount to have in a portfolio. Those were important factors, and if you like them so far, don't forget to click the subscribe button, as it does really help out, and I do a lot of content on stock investing, dividend investing, and all sorts. So if you're interested in that, definitely click that subscribe button down below. So, how can you calculate the number of shares needed to generate £100 in monthly dividend income? Well, first things first, if we're getting £100 a month, we're going to have to multiply this by the number of months in the year. So we're doing 100 times 12. That gives us an annual dividend figure of £1,200 per year. Now what we can do is we can go back to our dividend data website, or any website you have that shows you the dividend yield. Again, we'll continue with Shell here, so let me just go down back to the dividend yield page. And I'm going to use the trailing 12 months yield because I think it's a bit more representative rather than a forecasted forward yield. Now their yield is 3.59% here. Therefore, I'm going to divide the 1200. I'm going to divide this by the dividend yield in decimal. So it will be 0.0359. This will tell us the value of shares that I need in order to get £100 a month in dividends from Shell. And based on the calculation here, which you may or may not be able to see, it involves £33,426 invested in Shell shares at the current price for £100 a month in dividend income. The beauty of this is that the more money you put in, the more money you can get out. Obviously, there's an element of risk that we have addressed, but the idea here is that there's a snowball effect. And over time, as you put more and more money into these companies, you can see a greater potential return in terms of monthly passive income, which is certainly critical. But we should be discussing if there are any risks or considerations to keep in mind when relying on dividend income. And there are a few of them. First and foremost, company financials. You should be keeping an eye on the idea of their total sales. Is it increasing? We want to see that typically. We want to see that the company is still growing somewhat. However, you might have bought a little bit more of a high yielder of a dividend, meaning let's say it's 6% dividend yield, and it's a company that's not really going anywhere anytime soon. This could be a business that, let's say, has very formidable and cash flows that are mature, and they might be making a couple £1 billion per year, but it's not growing. That's okay. We can understand that some businesses have just reached the peak of where they're at. It's not ideal in a dividend growth strategy, but if you're after just a high yield, then this can work. In this case, we just want to make sure their profitability is consistent, the business model has a competitive moat, and really to check the company financials here, the main thing we want to be looking at is really the balance sheet. Do they have much cash available on the balance sheet? If we go back to Simply Wall Street here, we can look at Shell and we can go to their financial health tab, and what we'll see is a statement of their current financial position, and we'll see here that actually they're in a decent financial position in where they have $42.1 billion in cash, and they have, well, okay, $57.4 billion in debt, but overall their debt to equity ratio is 29.3 times. We can also see that Shell's debt is well covered by its operating cash flow, which means it covers it by 1.2 times. So we can see that Shell is in a strong financial position, which gives us a bit of a tick here because it means that there's ultimately less risk of this stock because they have a better quality balance sheet. Now, if you picture a business that has loads of debt and very little amounts of cash and an unstable earnings, so let's say their earnings is inconsistent, some years they're unprofitable, well, this is not going to be an ideal dividend company because there's too much risk baked into the shares, and it's very likely the dividend can get cut, which is the next risk. Once we've addressed the stability of the cash flows, and I'll show you here with Shell, see how you've got the earnings and revenue history, and you can see how the revenue is very cyclical, goes up and down consistently over time. But in that time period, you know, they had decent cash flows and they were making a fair amount of billions until 2020, where obviously we had the Russian oil crisis, or whatever you may call it, where prices were negative. Understandably, they were losing money in that period of time, hence why. And that's when we go look at this chart to see the dividend history, and we can see, oh, well, yeah, they actually cut it because this staircase has now dramatically decreased. That's a concern that needs to be addressed. So it's all about finding companies that are stable and growing for the longer term. Hopefully we see a company that's growing its earnings by, say, 5, 6, 7%, single digits, high single digits, maybe even double digits if you can find them for a good price. Find those companies and let them set and grow over the longer term. A good example of this in the UK would be the likes of the London Stock Exchange group here. Now, the dividend yield is much on the lower end because, as I said before, people are buying shares of this stock because they value it. They think it's a premium, they can pay a premium to earnings, therefore they think it's a high quality investment. Not all stocks with a low dividend yield have that, by the way. The reason I say this is because when we go to the dividend history page, you can see the staircase of increasing dividends and the steps are getting steeper over time. Over the last 10 years, they've managed to grow their dividend by nearly 15% on average per year. Now, if we think about that and say, well, okay, well, let's look at their dividend yield history, right? Let's go back to the dividend yield page and we look over the last 10 years. Well, the dividend yield has actually been decreasing from 2.25% and it's been sat around 1 and less than 1% in 2020. This means that the dividend has been growing at a slower rate than the share price has historically. The dividend is growing at 15% per year. The share price was likely growing at a faster rate than that. This is because this company has very consistent cash flows and a strong, wide moat that can weather economic downturns, and it is stable and can, you know, avoid a lot of market volatility due to its sizable cash flows. Therefore, we can look for companies like this and identify strong dividend-paying stocks. Now, if you didn't know how to identify some strong dividend-paying stocks, I've actually got a Patreon, which you're more than welcome to check out. Every single week, I write a Stock Watch report, which goes into great detail about various companies in the United Kingdom. We talk about the business model, the competition, biggest risks facing them, biggest competitor facing them, as well as some outlook growth opportunities and an overall stock analysis. So if you're interested in something like that, I've actually got a free 22-page report on Boohoo stock. So definitely go down to the description down below and go and check that one out. So, what are some strategies or tips for building a diversified portfolio to maximize dividend income? In my opinion, you have to really choose one or the other. Do you want a regular, consistent £100 a month in dividend, in passive income? Well, in order to do that, you need to hold a large basket of different stocks and shares. Or, if you're looking to perhaps maximize the overall stability and growth of the portfolio, maybe you're looking at less and you're looking at a handful, up to 10 maybe, and that could be more of a sweet spot for you. But ideally, what we need to do here is address which sectors and industries each of these stocks are in. So you might have picked Shell as one of your dividend-paying stocks. fantastic. It's a quarterly payer, and we've addressed that before. Now you might pick another stock in a different niche. It might be GlaxoSmithKline. GlaxoSmithKline in the pharmaceuticals, obviously, and they also pay quarterly. Well, here we might have different paying months for their dividends, and this is now going to compound your machine. So if we can find a diversified portfolio that can generate us passive income over the longer term, we've got a good strategy for dividends over that time period. Now, I now advocate for the core and explore strategy. This is because I've tried my best being a stock picker, and I still remain to be a stock picker, but I do think it's a very challenging thing to do, and if you don't have the time or energy to do so, then in my opinion, I think index funds are better suited. Now, there are some dividend-paying index funds that could be worth investigating. For instance, we could look at the S&P High Dividend Yield Fund. And ideally here, what this does is it's an index fund that looks at some of the largest companies in the world and looks for those with high dividend yields. This could add some passive income, but some much needed diversification in your portfolio, which could be ideal as an investor for the longer term and navigating market volatility. Overall, hopefully we can reach that £100 a month in passive income through dividends and see that dividend snowball effect as it grows over time. Thank you for watching. Have a fantastic day.